Well, I think top of the mind really is, the tariff situation and how it's going to impact the Chinese market. And as we can see, last week was an epic week for the Chinese stocks, right? So Hong Kong stocks suffered a really bad sell-off on Monday, but then we staged a really strong comeback. I think traders are expecting Beijing is going to come up with new stimulus measure, to sort of offset the impact from tariff. But I think so far, there's very scant details being announced, and also the social financing data is actually stronger than expected because the Chinese government is selling more bonds than expected. So obviously, physical machine is starting to work. So I think hopefully, with a little bit of steam being let off from the U.S. side, this week we can have an even further rebound from last week's low.
Is the floor in, you think, in markets, Chinese markets specifically?
I would say the 19,000 level for the Hang Seng last week is a really good and a really good entry point with a reasonable valuation as well.
I think traders are also trying to understand the relative strengths of the US and China as we enter in possibly or are in an economic war. And you mentioned treasuries and the tools that China has at its arsenal. Do you think that they're also intentionally selling their holdings to destabilize?
Yeah, one shouldn't be too surprised to see, right? So, because in this negotiation, China has less negotiation chips than the U.S., right? So, you have to resort to things other than tariff, other than imports and exports to put pressure on your opponent. So I think last week, when the tariff was first announced, the U.S. Treasury actually rallied substantially. I think 30-40 basis points in one day. But then suddenly, there was some sort of a forced selling in the marketplace, and therefore, it probably blow up some basis trade. But I would say that the trigger is actually set off by some Chinese selling as well. Even though they're saying that, most of the Chinese holding of U.S. Treasury, is with the U.S. banks, right? So it's the U.S. banks acting as a custodian for the Chinese holdings. But then at the same time, we all know that there are like lots of Belgian accounts the Chinese government use to accumulate the U.S. Treasury bonds. So you can sell some of those holdings as well. So I think last week has been a very sort of a volatile, epic week for all assets, not just for the Chinese stocks. I think for the U.S. stocks, it went through a tremendous volatility period as well.
Yeah, it was a bit crazy with the VIX above 40, which is really a level that you don't normally see apart from periods of stress. But speaking of the lack of, or the glass is half full on ambiguity, the U.S. president is in fact speaking right now on Air Force One, talking about how the financial system, it's very respected, that there should not be any ambiguity in financial markets. I guess, tell me this then, we've seen several downgrades to Chinese growth, economic growth. I think Goldman Sachs also came out and slashed their forecast. Will there be a hit to earnings in China from this?
Well, I think, one shouldn't be too surprised, right, to see a huge hit on Chinese earnings. I think, if we assume that all the exports to the U.S. go away, right, so then obviously there will be ripple effect on, the factories that is operating here, manufacturing just for the U.S. destination. So one should be too surprised to see 1.5% to 2% hit on the Chinese GDP. Right, so this year we're trying to do 5% growth, and then we have to reduce it to like 3-ish% for 2025. So if so, then many of the export-oriented companies will get hit as well. So I think right now, even though the market is starting to price in this kind of ultimate scenario, but in terms of earning expectation, we're still not seeing analysts downgrading their earnings estimates that much.
Actually, on that point, there's some interesting news out about plans from JD.com, Meituan, Alibaba's Fresh Hippo to try and sell more of their export-oriented products to a Chinese economy.
Well, I think the Chinese government has been trying to stimulate the domestic market for a long time now. I think ever since 2007, right? So the Chinese economy was talking about restructuring towards a consumption-based economy because in so doing, then the economy would be less volatile, right? So it would be less investment-driven. and therefore, the volatility in the GDP growth would be substantially less than before. But then over the past 10, 15 years, for some reason, we're even more export-driven than before. We're even more investment-driven than before. So I think as a result, now we're entering this sort of a tricky period where you have to cope with the pressure from the U.S. And then at the same time, your domestic market isn't fully mature just yet, right? So the Chinese consumption as a percentage of GDP is less than 50%. It's one of the lowest in the world, especially considering now the Chinese per capita GDP is about $14,000 US, right? So it's quite substantial. It can be classified as almost like a middle income country, but then at the same time, for some reason, consumption is still not boosting up.
What would you recommend investors to buy?
To buy
In this market.
Well, I think last week, we were seeing gold, for example, and the gold miners stage a really strong performance, and also the SOEs, right? So the SOEs are going to get subsidies and supports from the government, and also going forward, after this huge volatility subside, one should be expecting the tech sector should have strong support from the government as well, because that is being regarded as a forefront for U.S. and Chinese competition going forward. So, and that's the reason why, after a huge sell-off last Monday, and then, the Hang Seng Tech Index is